Good morning, everybody. I think we'll start. So thank you, everybody, for coming on today's webinar. Topical, lots and lots of people on. First of all, for those of you who don't know me, I'm Crystel Rynne. I'm CEO here at HRLocker, and I'm delighted to have Niall Clarke with me, lead product manager from PaycheckPlus, and Brona Grogan with me as well, CEO of PaycheckPlus as well. So thank you both so much for coming on today. I think that we've worked with PaycheckPlus for the last couple of months, and I think probably both sick and tired of hearing about me asking about auto-enrollment. So we decided we'd put something together for everybody and hopefully answer some burning questions that everybody has. I think the key thing around auto-enrollment, Niall, is that we ran this webinar, I think, about 18 months ago, saying that it was imminent and coming in a few weeks' time. So I'm hoping that we're there at the moment. Brona, I suppose if you want to just give a brief overview of PaycheckPlus, what you guys do and where you're based, and start there.
Absolutely, Crystel. Good morning, everyone. It's lovely to be with you here this morning. Thank you all for joining. I can see quite a high number of attendees this morning, so there's clearly a huge interest in auto-enrollment and what that will mean for your businesses and ultimately your employees. So I do hope you enjoyed this session. PaycheckPlus, as Crystel says, we've recently partnered up over the past few months with a view to going to market with that integrated HR and payroll solution. So obviously, Crystel's team come in with the HR end of it, the front end of it, shall I say, and then my team then will deliver to your payroll needs. We are originally an Irish-owned business, which was acquired by Iris Software Group in April 2022. So our vision again is to go to market with leading payroll solutions across all sorts of payroll frequencies, all sorts of payroll sectors, all sorts of payroll sizes. The team are predominantly based in Drogheda, in County Louth. We've actually recently moved offices, and some of them work in a hybrid capacity as well. And I think what our customers are finding at the moment is a lot of our team now are probably UK based as well, which obviously would come as no surprise, seeing as we were acquired by a UK company, as I say, a few years ago. And obviously our payroll then, our service delivery is via a workflow and an employee payslip portal, but we can get into more about that at a later stage. For now, I invite you all to, as they say, sit back, relax, and enjoy Niall's presentation. It's hugely informative and obviously will be supplemented then with some further material as well. And if you have any questions, you certainly know, or you will know where to find Niall and or myself. Thank you.
Thank you so much, Brona. And so, Niall, I'm going to pass it over to you. There is the questions and answers section. So please, if anybody has any questions, pop them into the Q&A section there or the chat, and I will pose them to Niall. I enjoy not being on the hot seat when it's somebody else taking the questions. So as many questions as possible. So over to you, Niall.
Brilliant. Good morning, everyone, and thank you for joining us today. You're all very welcome. My name is Niall Clarke. I'm lead product manager here at PaycheckPlus by Iris. And I suppose, look, today's session is designed to give you kind of like a clear understanding of the upcoming auto-enrolment scheme in Ireland and what it means for you as an employer. And I'll walk you through some of the key points and highlight what's most important from a practical standpoint. And as Crystel said, try and answer as many of those questions that you may have. So the agenda for today's webinar on screen now at the moment, we're just going to kind of cover through briefly what auto-enrolment is. We'll go in and cover some of the eligibility criteria that NERSA will carry out. Show the contribution rates and some of those working examples. We'll explain the key features and functions of the scheme, or NERSA. And then we'll jump into the payroll process map just to kind of show at a high level view how straightforward the process from a payroll perspective will be. And then we'll kind of finish off by covering some of the touch points in relation to the portal registration, and then a little employer readiness checklist. We've got a more informative guide to the slides that we're showing here that we'll share afterwards. But for the purpose of this, we'll just try and kind of keep it slick and short. So I suppose let's jump straight in. So what is auto-enrolment? Okay, so auto-enrolment is state-led, right? It's backed by the Department of Social Protection. So it's a state-led pension scheme intended to ensure that employees who are not already saving for a workplace pension have access to one. It's there to supplement the current state pension, right? It's clear that we understand it's not there to replace, it's there to supplement. DSP have created a new statutory body, so that's who's going to manage it. That'll be NERSA, National Automatic Enrolment Retirement Savings Authority. They didn't make that one short, right? So I'll just refer to them as NERSA going forward. And that'll be under the oversight of the Pensions Authority. The system will be called My Future Fund. So I'm sure we're hearing lots of stuff around Irish pension, state pension, auto-enrolment, etc. My Future Fund is what the scheme is going to be called. And we're probably starting to see those advertisements and campaigns coming out as well. It will commence the 1st of January 2026. Like Crystel said at the beginning, it's going to go a year ago, a year before that. Then it was supposed to be September this year. It is absolutely set in stone now. It is going on live on the 1st of January. So I think that's exactly 6 weeks from today. So it's coming soon. And it's just worth noting that Ireland was actually the last OECD country without a retirement auto-enrolment scheme. So we're a bit behind our counterparts. But I like to look at that as a good thing, because we've learned from some of maybe the mistakes or pitfalls of other countries that adopted it many years ago. And hopefully, as you'll see throughout this webinar, it is relatively straightforward. So eligibility criteria. Just one point to note on this one, because a lot of questions come up. It won't be the employer's responsibility to handle the eligibility criteria. That'll all be performed by NERSA. So that's a good sign for the employers out there. And basically what they're looking for is auto-enrollment will apply if all three of this criteria is met, right? But it's across all employments. And again, that's why NERSA are handling the administration or the eligibility criteria, because the employer couldn't. Employer only has sight of that single employment, whereas NERSA will have sight of the employee's entire employment. So that's why they'll carry out the checks. And what they're basically looking for is they're looking for 3 triggers. So when they are supplied with the information from payroll through to revenue, and revenue supply that information to NERSA, what they're basically looking at across an employee's entire employment history is, have they got earnings and combined earnings of 20,000 or more per year across one or more employments? Their age eligibility as well, so age between 23 and 60. And then they're looking for any pension triggers on those payroll records. So if there's no existing pension scheme already for that employment will be exempt. And those pension schemes are quite a few, right? So occupational, PRSA, RSCs, PEPs, ABCs, ASCs, etc. There is a voluntary opt-in for employees that are outside of that income threshold and are also outside of that 23 to 60, and it's open for anybody between 18 and 66. So if they don't meet all those eligibility criteria but are between 18 and 66, they can voluntarily opt in through the NERSA portal. Some of the employees that are in scope, I suppose the easiest way to explain this is all employees are within scope. That's what NERSA will be looking to assess and then determine the eligibility criteria against them. So that's, employees on probation, casual, seasonal, part-time contracts, apprentices, etc. And then what they'll be looking for in that revenue collection data that they're getting from payroll is PRSI classes within that section. So primarily A, most people are on A, but it'll also include anybody on class B, C, D, H, or J. Worth to note, might not be that common, but supervisors in any of the C or job initiative schemes will be included in this, but the participants within those schemes won't be. They fall out of the remit. Also exclude self-employed. and anybody with a PRSI class M, I think that's normally anybody on a drawdown of an occupational pension scheme, class S covering those self-employed. And then I mentioned NA and X, that's kind of software dependent, but they're primarily guys that have PRSI exclusions. So they're out of scope for that. So NERSA will do this. They'll handle all that information based on what we are supplying to revenue through payroll. So we don't need to worry about that. And they'll simply just notify the employer or payroll via AEPNs, which are automatic auto-enrollment payroll notifications. And we'll just supply the calculations through payroll accordingly based on the information that they send through to us. So the contribution rates. So the contribution rates will start as follows. We'll see they'll start at 1.5% for the employee, matched by the employer at 1.5% also. And then there'll be a state top up of 0.5%. So that's a combined total in years 1 to 3 of 3.5% that the employee will get. The employer cost will be that 1.5%. And then progressively as the years go through until we reach 10, the rates will increase. So employee and employer rates will increase every 3 years by 1.5%, as you can see here, and with the state contribution increasing by 0.5% in each of those 3 years as well. Until we get to year 10, when the scheme is kind of set in stone, that's it. And those prevailing rates will be 6%, 6%, and 2% state top up. So in relation to the contributions are capped at 80% earnings, but again, that's across all employments, not just a single employment. And once NERSA have sight of that from the information going from payroll to revenue and then on to NERSA, they will produce a new AEPN notification that will hit each of the employers and each of those employments to stop all contributions. That'll be employee, employer, and state-led contributions. They'll stop once that 80K earnings cap is triggered within the tax year. It gets reset then at the start of every tax year, but once they reach that within the tax year, contributions will stop thereafter. As I said, they're phased in over 10 years, fixed at the prevailing rates as shown on the table here. And then one thing to note, I suppose, is it's not possible, like maybe some of those occupational schemes where you've got AVCs, additional voluntary contributions. These rates are fixed. There is no opportunity for an employee to contribute more than the prevailing rates at the time. And then lastly, I suppose employers will match the employee contribution with the state providing that top up, but that state top up is in lieu of tax relief, and we'll explain that a little bit more on later slides. So there are the contributions, just to give you a little bit of a working example of how those contributions might work for you, the employer, where maybe, you know, your employees have multiple employments within your same organization, or maybe they've got jobs elsewhere. So we can see here on the first example, it's an employee with 2 employments and no pension in either of those employments. So we can see that job 1 is less than 20K, right? So if you think back to those eligibility tests, you kind of might go, oh, that one's not eligible. Job 2 is less than 20K as well. But again, as I said before, what NERSA are looking at for those eligibility checks is the earnings across all employments. So when we add the 2 of them together, or NERSA add the 2 of them together, they're over 20K, they're sitting at 33. So that means both those employments will be accessible for the eligibility criteria, and then depending on whether they're in the age category 23 to 60, or they don't have a pension in these examples, then auto-enrollment will apply. So on that example 1, it just kind of shows what in the first 3 years, what the employee contribution will be, what the employer contribution will be as well, and then the state top up. So you can see there that employee total contribution in year 1 to 3, if they stay at those earnings levels, will be 1,155. If we flip down then into example 2, where the employee still has 2 employments, but they've got pension in 1, again, it follows the same principle. Both individual employments are under 20K, but combined they're over, so they're accessible for auto-enrollment purposes. We can see job 1 doesn't have a pension, but job 2 does, so job 2 becomes exempt. And again, the AEPN notification from NERSA will mark that one as exempt, but employment 1 isn't because it doesn't have a pension, so auto-enrollment will apply to that. And you can just see the difference in that kind of years 1 to 3 total contribution. It's quite a significant drop, but that's, I suppose, because they've got pension coverage in that job too. So what I tried to do here, and don't take this as being the Bible, it's just a little bit of an example that might help from a kind of visual perspective and support with your organization's kind of budgeting and cash flow for what these contributions might look like. I decided to put this together showing like the minimum style contributions based on somebody on 20K, but bear in mind, as I said on the previous screen, you might have an employee earning 15, but they've got a second job, so auto-enrollment could apply. Just trying to keep it kind of simple here. Somebody on 20K, somebody at the 80K. So trying to kind of budget out that high min and max contributions. We can see here in year one, from an employer perspective, that employee could, or employees within that range could start as little as 300 a year employer contribution. So that'll be the employer's cost, up to anything around 1,200. So you could sit somewhere in there. So hopefully that this slide here will just visually represent, you know, and support you with budgeting and cash flow purposes. But you can see over the course of those 10 years, the contributions kind of quite clearly add up. And you can see in the highlighted columns there what the associated employer cost would look like. How they stack up. So just put this together as well, just to kind of compare auto-enrollment, the state-led scheme, versus maybe a typical occupational type scheme. So look, while the My Future Fund is a great initiative, right? The state scheme just might not be suitable to all employees. So I suppose what they've done here is, with the AE scheme, they've tried to follow a similar process to what's in place legislatively from a PRSA perspective. So very similar to PRSA, just with the exception of tax relief. So it's a state top-up contribution, kind of equal to 25%, rather than a PRSA that could get at marginal rate anywhere between 20 and 40%. But if we look at it here, just comparing some of the technicalities behind both schemes, you can see here in relation to an employee and employer contributions, they start under AE, they start at 1.5% and then gradually go up until it reaches year 10. They're set in stone, they're fixed, you can't control them. That's what they are. Whereas I suppose on an occupational scheme, those percentages are a lot more flexible, right? AVCs as well as the next thing. So no AVCs allowed in the My Future Fund, but occupational schemes, as I mentioned before, are open to AVCs. The tax relief point that we mentioned, there's no tax relief for the AE scheme. It's purely a net deduction, but it's topped up by that 25 or effective 25% tax relief via the state top up. But under occupational, an employee can get anywhere between 20 and 40% depending on their marginal rate of tax. Again, accessible from occupational pension scheme purposes. You can draw down, or employees can assess that fund from anywhere from the age of 50 onwards. The AE will only be accessible from age 66 onwards. That's the current kind of state pension age. Preserved benefit, employee benefit, so that'll be protected from day one under AE. So employee will assume ownership of those funds, and those funds are theirs. Under occupational schemes, that doesn't really kick in until 2 years or more into the scheme. And then the control piece. So employers have full control under occupational scheme, which could be a good thing or a bad thing, right? Full control also could potentially mean more administration, more charges, etc. Whereas from the AE perspective, there's none. It's all handled by NERSA. There won't be any BIK exemption, or sorry, there is a BIK exemption for employees on employer contributions. So that kind of follows suit like PRSA. The state top up on any investment growth will be tax-free as well during the life cycle of the scheme. It really only becomes taxable like PRSA does on retirement or drawdown. And the tax-free lump sum on drawdowns is equal to 25% of the value of the fund, again, similar to PRSA. So some key features of My Future Fund or NERSA. First one is pot follows member basis. So again, as I said before, these pension funds are owned and controlled by the employee. It's the employees themselves that can decide, you know, as they move from one job to the next, it'll follow them through that life cycle. They own it. They also can control the investments on which that fund goes into. So I suppose what NERSA will do here, or what the My Future Fund will do, is it'll gather the employee, employer, and state contributions. it will then put them into a temporary NERSA pot, where NERSA will then, through the fund managers, they'll invest that through the various options, and those options will, I think they're set to start off quite low risk initially, but as the scheme evolves in later years, and I think they're planning before year 7 starts to have maybe, you know, better investment options available. And then effectively, basically, once that investment option is selected, it'll ultimately go into the employee's pension pot where it'll be invested, and the growth will happen there. NERSA and the My Future Fund will also handle the drawdowns. So again, retirement at age 66, currently in line with the state pension age at the moment. So you can't draw down before. The only 2 instances where drawdown can happen before 66 is serious illness retirement. That'll be something that the employee will have to manage through NERSA as well. And then look, unfortunately, on passing or death of that employee, it'll be crystallized just like any normal pension scheme would be, and will form part of the estate. And then at that stage, drawdowns are possible. Some other key functions of NERSA, I suppose, again, just to hit home around NERSA trying to handle as much of the administration as possible and make that burden as light as possible for employers. They will handle all the eligibility determinations. So again, using that revenue data, that revenue collect from us through payroll, they'll take that information together with their rolling 13-week look-back period. And once eligible, NERSA will inform employers via that AEPN, that auto-enrolment payroll notification received by payroll. And that's received quite similar to how the RPNs, the revenue payroll notifications, are received today. So your payroll software should have an additional button in due course that allows you to scrape the RPNs from revenue and also the AEPNs. And those AEPNs are just going to say auto-enrolled, opted in, opted out, suspended, left employment, all that lovely stuff. NERSA will also handle the contracts and the compliance side of it. So they are the authority who administer the scheme, and they're doing that in the best interest of the employees. So they'll cover the contracts with investment managers, they'll handle any resolution process from non-compliance or any complaints, and then they'll also be responsible for issuing any fines and penalties for non-compliance. The secure portal, again, it's their secure portal. They will manage all aspects of it from both the employee and the employer perspective, and they'll provide information to both along with certain assets. So I think we got confirmation earlier this week that some of those assets will be around when the scheme kicks off in January and employees are assessed and auto-enrolled. There's an obligation on the employer to inform all those employees who are enrolled in the scheme that they have been enrolled and the effective date of that enrollment. And I think what NERSA are looking to do on the secure portal is make those assets and collateral available to both the employee and also to the employer on their portal. Although the employee will receive that same notification, it doesn't remove the obligation on the employer to still do that notification and inform the employees that they're auto-enrolled as of from this date. But hopefully NERSA's portal, when it's available, will cover those assets. I think it's just a simple case of downloading those assets and distributing them to the employees. NERSA, through this portal as well, will also handle all the compliance stuff, from reporting the information back out of payroll to revenue and revenue into NERSA's portal, and they'll also handle the collection of monies and any refunds that might go through in those refund periods. They'll also handle all the suspensions. So this is a bit of a noisy slide because it is a little bit complex, and I wanted to just explain the information that's in here because a lot of questions come from this particular slide. And it is quite busy, but again, just to put that reassurance that there is a lot of information that goes behind the suspensions, the opt-outs and the re-enrollments, but it's to just explain that NERSA will handle this, right? It's not the employer that needs to handle it. The employer simply just acts on the instructions that they receive from NERSA. So In relation to the suspensions, again, this is all employee-led. It's the employee that decides what they want to do. So suspensions will only be available after 6 months of participation, and that's quite standard across most of these. The scheme is designed to be an opt-out basis rather than an opt-in basis. I suppose DSP and NERSA are hoping that they'll capture as many employees as possible. And by the time 6 months mandatory participation is up and we hit that month 7 and month 8 window, that opens up for suspensions and opt-outs, that most employees will just be happy with the fact that they've, got a pension now and it's been deducted through payroll for the last 6 months and they don't opt out. But the option is there for employees. What the suspension basically means is it's a temporary pause, so contributions can be paused for a minimum of 1 year, a maximum of 2 years. We believe there'll be a date selection available within the portal, so when the employees log on and suspend, that they can pick a date as to when they want to come off that suspension. If they don't select that date, as I said, it'll just be for a maximum of 2 years, and then they'll be pulled back in. During the suspension, there'll be a pause not only for the employee, but there'll be a pause on employer and state contributions as well. Anything that's already in the pot will stay there. There is no refunds. It's just temporarily pausing those contributions. Opt-outs, similar enough to suspension, but I suppose a little bit more permanent. Again, mandatory participation in this scheme for any eligible employees will be 6 months. And then the opt-out window will open in months 7 and months 8. Now, again, it's a bit of a shame that we haven't seen the portal yet. We're told early December. I heard something this week, it'll be the 1st of December. But again, from what we're being told, employees will notify NERSA of the opt-outs and suspensions around the online portal. And I believe that the employees will also have a trigger or some mechanism to know when months 7 and month 8's opt-out window opens. There'll be some sort of a trigger that'll say, right, it's open now and it closes on this date, just to give that visibility to employees. Refunds of contributions for opt-outs can be refunded, but it'll only be the employee contributions that will be refunded. Any employer or state contributions will stay in the pot. Any of those contributions in the first 6 months will stay in the pot. And I suppose the purpose of that is to continue to have some sort of pension pot value for those employees come retirement age. So it'll only be the employee contributions that can be refunded at opt-outs. Any other refunds can also then happen when the rate change rules come into effect. So at the moment, that's years 4, years 7, and years 10, because for the first 3 years, the next 3 years, and so on, it's locked at those prevailing rates. But also when we hit those rate changes, a new kind of opt-out period will happen in months 7 and 8. So employees have that opt-out window again. And then re-enrollment, so auto re-enrollment will happen for any of those employees who opted out or suspended but still meet the age or still meet those 3 eligibility checks. And that auto-enrolment will happen every 2 years, a cyclical 2-year cycle. Again, when that re-enrollment happens, similar to suspensions and opt-outs, it'll open up that new 6-month mandatory participation period, followed by the option to then subsequently or again opt out or suspend during months 7 and 8. So seems a little bit complex. It is to wrap your head around this slide. There's a bit going on, but just to give you that reassurance again that it's the employee that decides the suspensions and opt-outs. Employers can't. Employees will notify of suspensions and opt-outs on the portal to NERSA, and NERSA will be responsible for tracking the timelines, and then obviously informing you, the employer, through payroll of when those suspensions end, any voluntary opt-ins, or when the re-enrollment kicks in. Okay. How it all works. So yeah, I put this slide together just to try and kind of give a little flavor of what it might look like in the day-to-day world of payroll for those guys operating payroll in-house. So we start at 12 o'clock here. NERSA will, as I said before, will determine all the eligibility stuff. That information will then flow down into payroll via the AEPN, that auto-enrollment payroll notification. All we simply have to do is just scrape that information and hold it within the payroll record. We'll then process payroll as normal and apply the prevailing rates at that time for anybody that needs to be enrolled and have those deductions made. So the payroll engine will handle it. Will handle the calculations, etc., and will also handle the returns made. So I think anybody familiar with the payroll process cycle, when we close payroll in today's world, we're pushing that PSR, that payroll submission report, back to revenue. That's the information that's going to revenue and subsequently on to NERSA. Like the additional button that we'll have for AEPNs, we'll have an additional button, or should have an additional button within the payroll software that will push that information to NERSA, which will be the contribution file showing here's the list of all the employees, here's their gross pay, and here's the contributions that we made. That's the information that will inform NERSA of how much to deduct, and NERSA will collect those contributions, and then NERSA will obviously handle those contributions through to the employees investment fund, and then the cycle will just repeat itself. Couple of things to note in relation to a payroll perspective, probably more so from a compliance perspective, is the contribution schedule that needs to be submitted and reported back to NERSA. Like payroll modernization that hit us in 2019, this on or before. So you got to submit the information to revenue on or before payday. NERSA is going to operate something similar, but they've got a strict cutoff time of 6:30 p.m. on payday. Anything that happens after that is going to be flagged for non-compliance, and I suppose they'll be a little bit lenient to begin with, but I suppose as the scheme matures, those compliances will ramp up. So it's really clear to understand and note and have your processes in place that, like the PSR submission you make, you must make the submission to NERSA on or before payday, but it's 6:30 p.m. rather than midnight that revenue can operate. And the main reason for that 6 p.m. deadline is NERSA want to close down their systems at that time. They want to invest the funds so it hits the employee's account as early as possible. Unlike traditional occupational schemes that may not get the money until the following month, they don't want employees to lose out on that growth window. And then obviously from 6:30 onwards, NERSA will then activate the payment collection. So again, slightly different to occupational schemes where that might get reported a month later and will get paid a month later. Can be beforehand, but typically it's the next month. NERSA will collect the money. So from a cash flow perspective, they will collect the money as soon after 6:30 on the payday. So if you're operating a weekly payroll, that collection or payment is going to be due by 6:30 every week, if that makes sense. And we'll get to that in a little second. Or if it's a monthly payroll, it'll be at that time. Hopefully that makes sense from the role of a payroll perspective. Again, quite busy, but hopefully I've made it a little bit more simple in the sense that we're just pulling down those AEPNs. So many acronyms. I trip over them. We'll pull down the AEPNs, and then once payroll is done and dusted, we'll just submit that contribution schedule to the NERSA portal. So I'd love if I could touch and feel the portal, right? So I could actually show you how simple this is. But unfortunately, as I said, early December, whatever that means. But that's when the portal will be live. What we did see is we saw some like mock-ups of what the portal will look like. We just can't share them because they're very much kind of beta test stages. But from what we've seen and what has been discussed, the registration process should be very simple. What I would say to everybody on this call, I would say, although it's not compulsory or it's not mandated that you do this registration, so you might be an employer that goes, oh, lovely, all my employees are already in a pension scheme, none of them are going to be eligible for AE, I'm not going to bother with the registration. The recommendation from NERSA is that you do the registration because they're carrying out the assessment. And if you maybe have new joiners that don't fall into a pension scheme right away, there's maybe a probation period before, If NERSA deem any of those employees to be eligible and you're not already registered in this portal, you're not going to be able to get those AEPNs, and you're not going to be able to submit the contribution schedules and make the payments. So you will fall into that non-compliance. So the recommendation is that you do it. It should be a 10 or 15-minute exercise. Basically, the way it works is the first condition is you need to have a ROS cert. So that'll be an employer ROS cert. It can be the main admin cert, or it can be a sub cert. It's just somebody who has that kind of PAYE registration linked to their ROS cert. That's the same ROS cert that you would use to log into to revenue. So you'll use that ROS cert to load in to the registration page and apply the password for that ROS cert, and then that'll bring you into the NERSA portal registration. From there, it's a 3-step process. First step is review the T's and C's and tick that you've acknowledged them on screen. That'll bring you from page 1 into page 2. Page 2 then is probably the most complex of all, because it's asking for the most amount of information. But again, that information is light enough. It's just information to be able to create your company profile. So it's basically just looking for company name, trading name if it's different to the registered name, the business sector, the number of employees, your address, language preferences, if you want it to be in English or Irish, etc. And then a method of communication. By default, it's electronic because they want to handle everything electronically, but I believe they do have a paper option there as well for postal. And then to complete the company profile, you just need to add your primary contact details. So that should be your day-to-day appointed person. If NERSA were to reach out to somebody, you want it to be this person that has oversight of the payroll process and can address any of those. So again, they're just looking for a name, an email address, and a contact number. And then it'll bring you to the final page, page 3, and that's just all around the payment method. So I think I said on the previous screen around the compliance side, the reporting to NERSA must be made by 6:30 on payday or on or before payday, because NERSA will come to collect that money straight away. So on the payment method screen, the last part of the process, the preferred method that NERSA wants is direct debit. That direct debit will have to be signed in accordance with the bank mandate. So I think there's a download option. So if the person completing the profile isn't the person that can sign, there'll be an option to download it and then come back and upload the signed one. The registration will be just sitting there as, completed as far as part 2. Standard direct debit stuff, they're looking for bank name, IBANs, BICs, addresses, etc. And that's their preferred method. And I think the reason for that being the preferred method, similar to revenue's reason, right? It's just easier, but way less administration, because the only other alternative is debit or credit card, and that's a manual process. So as I said before, the payments on like traditional pension schemes that might happen in bulk a month later, NERSA are going to look to collect and initiate those payments as soon after 6:30 on payday every pay frequency. So if it's a weekly one, if you set up by direct debit, very little maintenance and admin that you need to do because the collection will happen instantly. But if you prefer to go the debit or credit card, you're going to have to remember for a weekly led payroll to go in on or before 6:30 every day and manually make that payment every single week. So I think that's why they're pushing and preferring for the direct debit. 1, 2, 3, right? It's as easy as NERSA say, right? Steps 1, 2, 3, portal registration will be complete. So again, as I said, it's recommended that this is done for those reasons as I explained earlier. If there's none of your workforce that are eligible, right, because they're in a pension scheme, so be it. Doesn't matter. You've got nothing else to do. You've done the registration with the NERSA portal. But again, in doing that registration and being compliant on that front, if NERSA were to send you or assess any of your workforce and say they were eligible, you will be none the wiser because you don't have that registration. So just to kind of hit home and make that point, it's really important to do, really easy. Should be the first week of December. I'm really hoping it is. And then I think this might be the last slide. We're good in time. That's cool. Employer readiness checklist. So I think, as I said at the beginning of the webinar, guys, we've got a way more comprehensive slide on this, right? Or document on this, goes into it in a lot more detail. That will be shared along with the recording and the slide deck afterwards. But just to highlight some of the kind of key points on that employer readiness checks, what we can do now and what we can do going forward. So I suppose, as I said on the outset, it's kicking in 6 weeks' time, right? Don't let that scare you, right? The registration, that window that opens on the portal early December, 3 steps, 10, 15 minutes, should be relatively straightforward. But what we can do now, if we haven't already done, is we need to, as employers, we need to understand our obligations. Hopefully I've tried to cover most of those on the slide so far, and then further on the comprehensive guide that comes later. But understand your obligations. Review that against any existing pension arrangements that you may have, and then that will allow you to be informed and decide what your AE strategy is going to be, okay? Engage with stakeholders, so that might be internally, it'll be your employees, finance, etc., from a budgeting perspective. So just make sure that you're engaging with those key stakeholders. And then probably the most important one here is communicate with your employees, let them know what's happening. Department of Social Protection and NERSA are doing their bit, but as an employer, we should be doing our bits as well. Review and update any of that HR documentation that may need to be updated in line with the AE obligations that come in. Payroll system testing and readiness. I know most of the software providers should be issuing their year-end updates and budget updates and next year's installs, etc., probably in the next week or two. So if you haven't been in touch with your payroll systems providers already, do so. Budget and costing models, right? As I said, I think on some of the original slides, I tried to show a min and max. Just do that work so you're aware of what 2026 and onwards will bring from a costing perspective. And then, yeah, look, sorry to say it again, but just make sure that you register for the NERSA portal when it comes up. Better to be there, better to have it. And then go live in January 26. Should be, as I said, should be relatively straightforward. Once you've done that registration, once you've engaged with your stakeholders and communicated to your employees, it's simply just running the payroll, right? You'll retrieve the APNs, you'll make the deductions, you'll submit before 6 p.m. on payday, ensure the payment method is set up. Again, direct debit, if you can. Card payment is just very manual. And then I suppose the second last point there is probably the most important one for here, is the employer's obligation to inform all enrolled employees that they've been enrolled with the effective date. Again, that NERSA portal should be providing those assets. We just don't have sight of them yet. And then just to kind of finish up on some of the key documentation that you can look at as well is, you know, having that auto-enrollment policy in place, introducing something just that explains the opt-out rules, re-enrollment, the obligations, what employees can do for suspension and opt-ins. Again, we're hoping the NERSA portal will have a lot of those assets and collaterals that you can just copy and paste in. An employee frequently asked questions pack is another good idea that we're suggesting. That just kind of explains the contributions, you know, that they're from net pay, no AVCs are allowed, they're set in stone at the prevailing rates, what the state top-up means from a tax perspective, etc., and even just maybe how they compare to traditional pension schemes. Map out your payroll process. Again, that slide I showed earlier should hopefully support on that one, but it's basically just ensuring that your payroll process is set up to capture those AEPNs, to make the calculations and report the contributions, and then the compliance aspect of it. And then just, yeah, budgeting any cost models that you may need to do just to support with years 1 to 3 at the lower rates, and then obviously going forward into year 10 when it gets to the higher rates. Some resources that I've shown here. So this has been my Bible for the last year or two. I look at it 20 times a day, all day, right? So most others don't, but I've just provided the top 4 links, really key links to stay up to date with everything. First 2 are really good. They're the government ones, cover everything from auto-enrolment, any webinars, etc., that they are carrying out, latest news and events, and their YouTube channel. And then the 4th one there is My Future Fund. That link is more of a technical link for software and developers, but there's a really good guide in there called the Business Process for Payroll Guide. It's a PDF guide, 80-something pages. but it covers a lot of the Q&A. It covers a lot of the scenarios that you might be thinking. Really good document, especially for those in payroll. It's a really key one to help understand how it'll work. And then look, you can follow us on socials and website. As normal, we're posting updates and communicating as much as we can in real time as and when we see it. And I think that brings me to the end of the slides.
Thank you, Niall.
I'm going to take a little sip before I go into Q&A.
Yeah, and unfortunately, you remember when you said that there'd be loads of questions within. So just take a sip of that water, because we have 53 questions to get through.
Okay.
So I will try to power through these, and if we don't get through all the questions, I'll send them on, and I'll kind of try to group them as we go. Okay, are you ready?
Perfect. Fire away.
I have a pension myself that I contribute to monthly. My employer does not contribute anything. Do I still have to join this program? It seems silly since I already have my own pension.
Good question. Simple answer. If that personal pension is being operated and going through payroll, revenue and NERSA will have sight of that. So then that employment will become ineligible or exempt. If it's a personal pension scheme that you have yourself and is not going through payroll in any fashion, so maybe you're making those payments via your own personal bank account, revenue and NERSA won't have sight of that. So that employment will become eligible. So you'll end up having both, and there'll be nothing you can do as an employee for that one because you're personally handling those payments. So what you could do is you could, in that instance, you could maybe speak to your employer and ask them, have they got a way to put that personal plan through payroll that could mark that employment as being exempt. But if it's not going through payroll, that employment won't be marked as exempt.
Okay. I think you've answered this, and I think there's a number of questions on this. So I'm just going to group it together. If we have a company pension scheme, will there be a way to let the revenue know the colleague is in a company scheme so they are not auto-enrolled? So that's basically once you're registering with NERSA, they'll see it, right?
Yeah. Like without trying to get too technical, the PSR submission that payroll submits to revenue, there's a pension trace marker on that one, and that captures both employee and employer contributions. It only needs an active record against one of those or both, right? It doesn't need employee and employer contributions to be made, just one or the other. Once that's there, that employment will be marked as having a pension, so it won't pass the eligibility check. So it'll be exempt.
Really interesting one is we have an employee who is over 60. Do we still need to register them in case they wish to opt in? So can they opt in if they're over 60?
They can. There's nothing. Two-part question. Nothing for the employer to do in terms of registration because that's all handled by NERSA. Between the employee and NERSA, the employee can choose to opt in, and that'll be done by the employee directly on their version of the portal by simply clicking the opt-in option. NERSA will get that information, and then again, the employer will be informed of that. So nothing for the employer to do, but the employee does have the option to voluntarily opt in.
Even if you've employees 62, 63, just register them all anyway.
Well, again, nothing to be registered from an employer perspective. That all happens via the payroll information that's currently going to revenue. But because they fall out of the age window, NERSA won't automatically enroll them. But that employee, because they're between 60 and 66, they can voluntarily opt in, but they'll do that directly with NERSA.
They can do it themselves. Okay. Complicated one. We have an employee who has a PRSA, but they've not contributed in the last 4 months. Will this employee fall into the scope? I presume so.
Yes, if there's no contributions been made to that scheme, even though that scheme might be active and going through payroll, if there's no contributions going through there, revenue will pass that information to NERSA, and NERSA will see it that there's not a single contribution being made, so they won't see that there's a dormant scheme there. That employment's going to be assessed for its eligibility, and if it passes, it'll be eligible. So it needs to have the pension schemes going through payroll need to have an active contribution from either employee or employer or both, but there has to be a monetary value going through.
We use PaycheckPlus. Will PaycheckPlus enroll us into NERSA, or do I, as the company, need to sign us up?
Good question. Again, I'd love to have access to the portal, right? Because then we'd know a little bit more about it. I suppose we can do it. What we're really doing on that basis is we're just capturing the same information that you would need, or the employer would need to do it themselves. We would capture that information and complete the registration. The issue with that is we still need a point of contact, right? Where we're not going to be that day-to-day point of contact. That needs to be within the employer's organization because it's the employer's responsibility. Our agent access will have oversight and be able to see this and be able to pull the AAPNs and do the reporting and all that lovely sort of stuff. But it's recommended that at least one person within the company's organization registers for NERSA directly, because a lot of that communication won't come to us. It needs to go to the employer directly.
I think this is, I might try to answer this one, but I think I know the answer to this is, what are the procedures if an employee's earnings change during a tax year? So they go below or above, that's just automatically going to be.
Yeah, good question. So I suppose we didn't touch on it all that much, but the 13-week look back period that NERSA are using, that's a constant rolling look back period. And in short, what it means is 13 weeks is equal to 5K, right? It's quarter of the year, 20K is the earnings. The minute NERSA see that employee has earned more than that amount or is due to earn more than that amount, auto-enrollment will kick in. Once it kicks in and it's active, it will never become dormant again unless the employee suspends or opts out. So what that basically means is, if the employee goes above or under that earning thresholds after they met it and reached the thresholds, auto-enrollment will still apply. It'll just be 1.5% of a lower gross pay amount than that higher, but it won't start and stop. The minute you're deemed eligible, you get it regardless of what earnings you have thereafter. Once you have an amount in the reported gross pay figure, auto-enrollment will apply at the percentages. Yeah.
And I presume this is, in theory, how it's supposed to work, is that there's very little involvement from the employer, right? So NERSA are just picking up those thresholds, right?
Absolutely. From an employer, the heavy lifting for the scheme is done kind of automatically by the payroll engine. What I mean by that is, all payroll or the employer has to do is pull down the AEPNs, similar to the RPNs at the start of the payroll cycle, ensuring you're always using the latest instruction, calculate the payroll as normal, and then submit the PSR to revenue and the contribution schedule to NERSA. That's it. Revenue will pass all that information on to NERSA. NERSA will handle all the eligibility, and the cycle will just rinse and repeat each pay frequency. The heaviest part of the administration is probably that employer having to notify the employee in writing of, you've been auto-enrolled effective this date. But as I said before, hopefully on the NERSA portal, those assets and collaterals will be made available quite easily for download. That's pretty much the bones of the administration, at least to begin with.
Yeah, and that's actually a question here to say is, where will we get the contract wording, which we're hoping from the NERSA portal. And then the other one is, will we get a dedicated account manager? So presumably it's the same as if somebody has a query an employee has a query in regards to that their PSI or POE was wrong, is that the employee will have to contact NERSA or revenue if they think that they've been wrongly charged?
Is this an account manager from the NERSA's perspective, or is this account manager from a PaycheckPlus perspective?
NERSA.
From a NERSA. Look, there's just going to be a compliance team there. Within the portal, you've got various communication methods. I think there's like in portal live chat functionality within there, and there's the ticket and resolution process that'll be available to both the employees and employers. So again, yes, NERSA will handle all that compliance stuff and the resolution process. It should be relatively straightforward to be able to do that within the portal directly. Whatever the outcome of that may be, that will determine then, does the employer need to do anything? And more than likely, that's going to be, make these refunds, because the refunds will go back to the employer to then pass on to the employee, or any of those non-compliance side of things.
Yeah. Are contributions calculated on gross and deducted from net?
Yes, a bone of contention for most
This was
people.
explained to me once, and I was like, I don't get it.
Yeah, and look, I suppose it's what makes it confusing is typically traditional pension schemes don't operate that way, but that's because they've got tax relief. A or My Future Fund won't. It's the state top up that equates to technically 25% tax relief. So the calculations are based on reportable gross pay before any deductions are made. So anybody that's familiar with looking at that PSO record, there's just a field in there that's gross pay. It's the sum of everything. All payments, notional pay, share schemes, bonuses, commissions, you name it. Everything that's in that gross pay, the prevailing rates will be based on that gross pay figure.
Okay.
Once that figure is calculated, 100, 200, 300, whatever it is, correct, it'll come off the net pay because there's no tax relief on it because the state top up will replace the tax relief. So the key important thing to note here is it's on the gross pay. If there's more than zero of a value reported on that gross pay, the auto enrollment will kick in as a percentage of that gross pay figure.
Yeah. If an employee has opted out of the occupational scheme, will they still be considered not required to contribute to the AE scheme only if they opt out on the portal, right?
Yeah, if they opt out within the windows, that opt out will cease. An opt out notice will come from NERSA back to payroll to say that that employee is opted out, and it will just sit there. We don't need to worry about when the re-enrollment window will reopen or the timings around that. That'll all be handled by NERSA. But yeah, basically in every 2 years when that re-enrollment window kicks back in, NERSA will recheck the eligibility of those opt-out people, and if they meet those eligibility criteria again, then NERSA will automatically enroll that participant back in. 6 months minimum participation. Month 7 and 8 will be the opt-out window again.
But it's not enough that they've just opted out of the company occupational scheme. They will have to go and opt out on the NERSA portal as well.
If they want to stop the AE scheme from kicking in, they'll have to do that on the NERSA portal. Yeah.
In the unfortunate event of death, is the pay down just what's in the fund, or will it be a multiple of your salary? Just what's in the fund, I presume.
Yeah, at the moment, the government have said, look, really straightforward, really simple at the moment, right? It's just 1.5% of this very low risk investment funds that are going into, etc. There isn't really any set minimum standards or criteria as such in relation to the scheme yet, but the government has assured us that before year 7, so by the end of year 6, there will be more standards in play, probably in line with current pension offerings. So yeah, just at the moment it'll be the value of the fund that will be crystallized and then just form part of that employee's estate. Revenue will handle it the same way that they'd handle any other pension scheme. So yeah, it's not like those maybe defined benefits schemes or whatever, that might be a percentage or whatever. It's the growth, more like a defined contribution. It's the growth of the value of that fund at the time the person passes.
This has actually been asked for a number of times, and it's an interesting one. People have been asking me as well. So if somebody starts on the 15th of December, are they automatically going to be enrolled in the 1st of January? And the other questions to put context in is usually we don't pay pension until 6 months after probation. So is somebody who starts employment on the 1st of January, are they automatically going to be opted in? Should we be getting them to
yeah, good question. And there is going to be a timing delay here. So if an employee starts employment with an employer for the first time, not their first ever job, just first time with this employer, NERSA have no idea that person has started yet, right? So until that payroll is done for the very first time, and that goes to revenue on the PSR submission, and then revenue pass that on to NERSA, NERSA won't pick up that employment yet to add it into that rolling 13-week look-back period. So by the time that hits NERSA, that rolling 13-week look-back period, they'll be doing on each and every cycle, they'll be doing that refresh to see, age criteria met, earnings criteria met, because the earnings mightn't be enough to begin with. So they'll constantly assess that. And once those triggers are met, AE will apply if the occupational scheme hasn't kicked in by that stage. So it's hard to tell what the crossover period would be, but what I would say is NERSA will not be assessing these employees on the very first payroll, because until that very first payroll is submitted by us to revenue, NERSA have no idea of that active employment.
Interesting. Yeah, and I think it is something that from a HR perspective, most companies will have to look and review. In that, I would say 99% of companies who are offering a pension scheme don't kick it in until 6 months probation. So I suppose it's something to review.
Yeah, it could apply
Yeah.
for those 6 months. The employee could opt out in months 7 and 8 and request a refund of their contributions for those previous 6 months. In theory, if at that stage they fall into the employer the occupational pension scheme. But yeah, until that happens, there could be a crossover period.
Okay, sorry. So okay, my staff have all signed up to the company's pension scheme. It will hit the payroll on the 30th of November. So actually, yeah, I know the answer to that. Register anyway, but there shouldn't be any issues, right?
Yeah. I'd again register, even though your current workforce are all participating in a pension scheme, because that pension scheme, like the last question, might not be available until 6 months of a new joiner starting, at which time NERSA and the My Future Fund will already kick in, so you'll be non-compliant. So just do the registration, and let's see what comes in on the AAPNs, because each employer doesn't have oversight of the employee's entire footprint, which is why NERSA handle it. So the recommendation is register. If nobody comes through, nothing to do. Anybody comes through, that's when your obligation starts.
Great question here is, we are a UK company with 1 employee in Ireland. Do we need to register with NERSA?
Yes. Again, if they're on the Irish payroll and they're being reported to revenue and they meet the eligibility criteria, auto-enrollment will kick in. So you'll need to be registered for it, if you don't already have an occupational scheme in place.
Yeah. I suppose similarly, we have a few employees in the UK, and we have to register with Nest, isn't it? So because of the enrollment there. Okay, so this is asked a number of times. Looking on the revenue portal now, can't see it because it won't be there till the 1st or 2nd week of December. Yeah.
And it won't be the revenue portal, so it's a completely separate. So DSP, Department of Social Protection, are behind it, but the authority is NERSA, completely separate to revenue, separate portal, etc. It's just revenue are sharing that payroll information to them for that eligibility side of things. It won't be in ROS that you're going into. It'll be the NERSA portal that you'll be going into for all things My Future Fund.
Okay, this is a great question. If I say so myself, from somebody. We'll just take 2 more questions because it's just gone past 12. Is if an employee contributes 0% and the employer contributes 1% on the company pension scheme, will they be opted in?
Nope, because the trigger mechanism will be in. Look, from day one, no, that employment will be exempt because there'll be a pension trace or marker on the payroll submission with a value against it. And again, it doesn't have to be both. It just has to be either or, employer. So that 1% will provide a value. NERSA will see that employment will be exempt. That's from day one, and for, as I said before, maybe for those first 6 years. But NERSA will be looking to bring in some minimum standard requirements, as the scheme matures. So that 1% today, not saying that it's a way to avoid being enrolled into the scheme, that 1% today may not be viable as that percentage tomorrow, if that makes sense, because when NERSA pick up these standard rules that they want to prescribe, it might fall, so it may not be enough. And they're looking to have those standards set in place within the first 6 years of the scheme being operated before year 7. So today should be fine. Tomorrow, maybe not.
Because it's a grey area.
It's a grey area.
Yeah. Okay, this will be the last question then, and then I'm going to give all these questions anyway. We'll maybe put them in an FAQ with the email that goes out.
Yeah, perfect.
Sorry, do does the company contribution have to match the nurses scheme, or do we have to match an employee? If the employee is just doing 5% in the company scheme, do we have to match?
For occupational, no. They have its own governed rules and set rules, etc. So if it's an occupational scheme, again, no requirement for both employee and employer to contribute or make contributions or deductions, and at whatever percentages. In terms of the AE scheme, that's set in stone. So if somebody is eligible or assessed as eligible under the AE scheme, it's fixed. There's no ifs and buts. It starts at 1.5 employee, matched 1.5 by the employer, and then 0.5% state top up, incrementally increasing over those 10 years. But in terms of the criteria for the occupational one, there's no minimum standards that need to be met to exempt that employment. So it can be as little, look, tongue in cheek, it can be as little as one cent, right? But I think we all know that's not going to be viable, right? NERSA are probably going to look at that at some stage as a compliance issue, because look, one cent's not good enough. But effectively speaking, to kick things off with, once they see pension on payroll of any value against employer, that'll be deemed exempt.
Yeah, and I presume that's exactly. So thank you so much. I think there's so many more questions. Sorry, I couldn't get to everybody's question. I think I kind of got broadly put them together. But lots and lots of questions. And we might do it again, perhaps maybe the first or second week of January, just to get people's any questions, or perhaps on how to register on the portal. I put you on the spot now. But
Yeah.
Be a good idea.
Yeah.
Rynne is like, Crystel, you did not sign up for that.
No, I'm supportive of that. That's absolutely fine.
as we know more, yeah.
Yeah, exactly. But I think, like I said, we've ran this 2 or 3 times in the last 12 to 18 months, and I think that there is no going back. This is coming in the 1st of January, regardless, right?
6 weeks.
Yeah, 6 weeks. So yeah,
6 weeks.
presume we can't turn around at this stage. But thank you, really appreciate it. Best way to contact you guys, if people have direct queries, perhaps go to the website would be a good idea.
Yeah, I suppose I didn't put that on the last slide, Crystel, but I'll provide my contact details.
You might regret that.
And the PaycheckPlus ones as well. If anybody needs to reach out, we'll add that in as part of the sharing, the recording, etc. Yeah.
I think the key thing to take away is that there's so many people, with over 350 companies on live here today. So you're not alone if you think that you have questions. Companies don't know, we don't know what to expect. So we're trying to give as much advice to people as possible. So please reach out if you have any queries. Yep. So thank you so much. I hope you enjoy the rest of this cold day, and we'll talk to you all soon.
Thanks, everyone.